This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, good morning, Jason Hartman and team. Thank you for all the great content, all the great guest speakers you have on. And Gina and I feel fantastic about doing what we're doing. And we'll just keep on listening and take care, and wish we could see you all soon, and hope that'll be happening. Take care.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1996, and thank you for joining me today. I just arrived home back from 2 weeks in Ecuador, specifically the Galapagos for 1 week and then Quito for the other week, and just had such a great time. What an awesome trip. A whole bunch of new friends, bunch of new socializing, and some really good experiences on the trip. So glad to be back, though. I tell you, I came home on a red-eye flight, which actually wasn't that bad. I usually hate red-eye flights, but they just fit into the schedule so nicely because you don't lose a day flying, of course. And my Uber driver was Colombian. And so we got in this big discussion about South America and how it's all becoming communist and the corruption and so forth. He was working for the government in the police department, actually, of Colombia, but sort of in a higher level, like administrative position. And it was just interesting to hear. And I said, why'd you leave? And he says, well, if you don't walk the straight line, that's the way he put it. If you don't walk the straight line, the people who are corrupt are going to get you. And we got into this whole discussion about how corrupt Central and South America is. Why is corruption just rampant there? And I don't think we are missing any of the corruption here in the United States, but I don't know, it's just hard to explain. I've struggled with explaining this over the years. I know we've talked about it on the show, how in the US, the corruption is legalized. It sounds funny to say that, but it is, and it just works differently in different parts of the world. People find a way to sort of, get things done, even in these kind of corrupt environments. Like in the US, if someone just outright bribed you, right? People would consider that mostly out of the box here. Like that's not cool. That's not proper. It's, certainly illegal in many cases. For example, the way government works and lobbying works, right? We know there's all kinds of corruption there. It's just indirect, right? There's a lot of ways you can do things indirectly. So it's just sort of interesting. But anyway, it was a great trip. Glad to be back. I hung out with a whole bunch of startup company founders, mostly pretty young people in their even early 20s, amazingly young. Hung out with a few people there that basically did marketing and publicity and public relations for big influencers. And it was interesting to kind of hear the inside story of the very dysfunctional influencer world. We used to call this sort of the Hollywood world, the celebrities in Hollywood and so forth. But, the modern day version is sort of the influencers on YouTube and podcasts and so forth. And hey, I'm one of them, to a small extent. My little corner of the world's nothing compared to some of these big influencers, like on YouTube, for example, like Mr. Beast, right? Or any of these big names. You all know who they are. I won't get into it. And that might have been a bad example of an influencer. I don't know that I'd even call it Mr. Beast directly an influencer. They're more like people that are hawking products, lot of cosmetics and fashion, a lot of influencers along those lines, but they're in every field. They're in finance and everything else, right? Anyway, it was an interesting time. Glad to be back. And I want to talk to you today about several things. And I'm going to end today with a daring prediction. Of course, a lot of people will comment below and they will say, oh, Jason, you're out of your mind, or Jason, you're exactly right. But I just really encourage you to listen to our Flashback Friday episodes, or if you're more interested than that and diving in, just go back and listen to any of the old episodes that I've done over the last 18 years. 18 years, right? Almost 2,000 episodes on this show. And then, of course, I have many other podcast shows as well. But just on this show, 18 years of predictions. And just look at how many of my predictions have come true. And I would say there was one major prediction I've made over the years, and I've kind of stuck to it, but I was pretty wrong about it. And I freely admit that. I've admitted it many times. And that is interest rates. I'm notoriously bad at predicting interest rates, but I'm going to make an interest rate prediction in this episode. And for some of you, it might kind of blow your mind. So we'll get to that. But the other prediction that I was wrong about is during the pandemic, I really predicted pretty bad things for New York City. And the Big Apple has kind of proven me wrong a little bit here. And I don't know, am I really wrong? Well, certainly if you look at the commercial real estate market, the eroding tax base of New York City, the skyrocketing crime rate, that's all bad. But I am really quite surprised that rents in New York City have held up as well as they have. They've gone up. Now, at first, they went way down. A lot of people were leaving the city, and a lot of people have left the city. But still, somehow, residential rents, and I believe, from what little I know about it, I'm certainly no expert on it, sales prices holding up pretty darn well on the residential side of New York real estate. So this is a prediction I'm kind of wrong about. I'm just putting it out there. Hey, listen, I have a secure enough ego that when I'm wrong, I can admit when I'm wrong. The interest rates, certainly, I've been pretty bad about predicting those. It's a centrally managed economy, and we never know how the central planners are going to manage things. And by the way, let me clarify my interest rate prediction thing before we get into some of this other stuff I want to share with you today. Back in the, kind of the 2004 to 2008, even to 2010, 2011 time period on this show, just go back and listen to the episodes. I really thought we would have higher interest rates than we did then. I thought there was just a lot of pressure for the Fed to raise rates. I thought mortgage rates would go higher, but, never underestimate the willingness of the central planners to sell out the citizens. And I believe that overall, they're going to continue to do that. And the big trend is going to be inflation. And they are going to, I'll get into it at the end and I'll tell you. I'll tell you what that prediction is here in just a few minutes. So let's just look at some data first. So if you are watching this on video, I've got some good charts and graphs on the screen. And by the way, for podcast listeners, we are trying to get this stuff up on YouTube faster. We are really making an effort. I've gotten on our team about that and really said, look, you got to publish these videos quicker because it comes out in audio form on the podcast first, but a lot of people want the visuals, so they want to go to YouTube and see these charts and graphs. So we are really making an effort to get them up on YouTube more quickly for you. So, if you want to see the visual side of it, you can. Okay, so let's talk about the banking crisis. I clip a lot of things from various newsletters I subscribe to. Some are free newsletters, some are paid newsletters. We certainly spend a decent amount of money over here on subscriptions because it's just important to be able to share this data and the insights with you. And so this is from Axios, and it talks about U.S. bank failures by share of total bank assets. You remember back to the Great Recession, the global financial crisis, whatever you want to call it. Of course, the big bank failure, the huge one, was Washington Mutual. And that represented 2.71% of all the U.S. banking assets, almost 3%. Now, the three big failures we've had recently, First Republic, Silicon Valley Bank, and Signature Bank, those all together represent less than WAMU back then. Okay, so just keep things in perspective there. They represent about 2.4% of all the banking assets. Okay, so it's definitely a much, much smaller crisis situation. But nonetheless, these are signals, and the signals are important. And this is why the Fed is in just such an incredibly difficult position. They have painted themselves into a corner. And I believe I know how they're going to get themselves out of it. And for most people, it's going to be bad news. But for you, because you listen to this show and hopefully you're following my plan, it's going to be great news for you. Remember, it's nice to say, it sounds really good when we all say, hey, the pie is big enough to go around. And look, capitalism does increase the size of the pie, much better than certainly communism or socialism. That shrinks the pie in most cases. But even then, the pie is limited at any given time. And some of these new technologies, like the artificial intelligence revolution that's going on, I think that is going to massively increase the size of the pie, which is great news. But the pain point to get there, and by the way, this might be a tangent alert, is a lot of job losses on the way there, right? So the economic pie is a relativistic game. And so as long as you can be ahead of the masses and your slice of the pie is growing or at least staying stable, you are way ahead. I won't bore you with that old sort of meme about the two hikers in the woods and, outrun the bear kind of concept, right? But that's really very true because that is the answer to the question, compared to what? The compared to what question, right? Okay, so this article goes on to talk about how the Fed was at pains to point out yesterday, quote, the U.S. banking system is sound and resilient, unquote. The chart begins to explain why they might be so sanguine. And again, when you look at these banking assets, and you look at the hold to maturity types of assets that the banks have that we've talked about many times, starting with the Silicon Valley Bank crisis a while back, it doesn't tell you enough information because it doesn't tell you what the maturity date is or what the rate is on those assets that the banks hold. But there is enough of this to concern the Fed and, I believe, to put extraordinary pressure on them to pivot, even though Powell is signaling that that's not the case. And at the last meeting, they raised again for the 10th time. I can't believe it. Are they out of their mind? Well, they got an inflation problem on the other end. So they've got to do something about that. They've painted themselves into a corner. And it's really, really a tough situation for the Fed. So this also talks about how the global financial crisis was also much broader and lasted for years. Between the failure of IndyMac in July of 2008 and the demise of National Republic Bank of Chicago in 2014, a whopping 501. Wow. That is monumental. 501 FDIC insured banks failed, collectively comprising more than 6% of total assets in the commercial banking sector. That was big, right? That was very, very big. So we'll see where this goes. But again, I think a lot of people are making it out to be a bigger problem than it is. But again, we shall see. Okay, so this is from another newsletter, and this is from one of my gold bug newsletters. I always want to know what the gold bugs are saying because, they have a good handle on things except for their investment strategy. Gold. Gold is so overrated. I mean, it's great to look at. I love the stuff. I certainly own a decent amount of it. I recommend you have a little bit for insurance, gold and the other precious metals. But again, you can't rent it out. You can't finance it for 3 decades at super low interest rates, negative interest rates below the rate of real inflation. You get absolutely zero tax benefits from it. It's actually not even right to say precious metals are not tax favored at all. Actually, they're tax disadvantaged. They're literally terrible tax treatment on precious metals. So, it couldn't even be just like, okay, it's actually quite bad the way the tax code treats precious metals. So not good at all. But of course, income property, the most historically proven asset class in the entire world and the most tax favored asset class in the United States of America. Fantastic, right? But the gold bugs do have some really good points. So here's them talking to the Fed, right? No need to panic, according to Jerome Powell. But I think we can see that the writing is on the wall. CEOs and CFOs across the spectrum have made incredible progress toward aligning their business model to the times. And real estate developers and portfolio managers have done the same. Let's think of this. Real estate developers are in a much different situation, a much worse situation than you as a real estate investor. Why would I say that? Because they do not get to take advantage of many of these wonderful multidimensional characteristics we have all come to love with our real estate investments. What are the multidimensional characteristics that I'm talking about here? There are many, but I'm only going to address this one concept. You've heard me talk before about my teachings and my learning module on the 3 dimensions of real estate. There's really more dimensions than 3, but hey, it's a catchy title, so I'll take it. The 3 dimensions of real estate. When we look at prices, and that's what developers have, they have that one dimension, right? They can only play the pricing game. They want prices to be higher so they can make more profits. But if prices don't go higher and they go down, then the developers stop building and there's a supply problem, a supply constraint. But we as investors can play our cards either way. We can play the capital appreciation market. We can play the growth market. We can play the capital gains market, and that's wonderful. But that's not really the core of our investment strategy. The core of our strategy is the yield market. We want to get good yield on our asset, and that means income. So when the developers stop building, when credit tightens, then all of those buyers stay in the renter pool, and all of those developers pull in their horns and they stop building, thereby decreasing the supply of new homes. And we benefit from that because we see upward pressure on rents. So either way this works, as long as you are tuned to it and you're investing in the right markets with the right strategy, with the right financing, you're using mortgage sequencing, a strategy we've been teaching for, 12 years now on the show here. Go to jasonhartman.com and type in mortgage sequencing on our search engine there and learn about mortgage sequencing. That's really important. As long as you're taking all of our strategies, right, and using them, you're going to be able to play either way, right? Your hand is not one dimensional like it is for the stock market, the business owners, the real estate developers. You can play many sides of the coin here, right? Okay, so, and then it goes on to say, everywhere I look, business leaders are working day and night to make sure they have a business structure that can thrive in a world of high inflation and credit tightening at the same time. That's the pickle the Fed is in. And it is a really, really difficult corner they've painted themselves into. So we see credit tighten. We see inflation continue. They can't seem to shut off the inflation problem. And they have raised rates like a hockey stick chart, that hockey stick graph where it just goes way up. And that's exactly what's happened. Entrepreneurs are doing everything in their power to get through this. So as we continue to see more banks struggling, it tells you one thing: the Fed is probably over tightening at this point. The Fed is probably over tightening at this point. And I could not agree more. But they've still got a problem. And the problem is a big one. But how can we benefit from it? That's the question we need to ask. And then they showed this chart that shows the flood, the absolute rush, the flood, the tidal wave, the tsunami of money coming into money market accounts. Folks, I'm part of this tsunami. I took some of my wealth and piled it into 6-month treasuries, right? I never thought treasuries could actually look interesting as an investment. CDs, treasuries, money markets, it's not great by any means, but hey, if you got some cash sitting around and it's easy to just stick it in there, it's not the worst thing you could do, right? And then this from a different newsletter: high interest rates, ? Inflation, ? Banking crisis, ? No problem. April's job numbers were pretty good. The US added 253,000 jobs with a 3.4% unemployment rate. Wow. Matching a 54-year low in unemployment. What do you do with that, folks? How do you solve inflation when employment is so strong, when the labor market is so strong? This is such an incredibly key proponent of inflation, because if people have jobs and if the labor market is tight, that means wages are going up. And wages are so quick and so direct as they are spent into the economy. And that just causes more and more inflationary pressure because it's just instant. I mean, every 2 weeks, people are getting paid and they're spending. And more dollars chasing a limited supply of goods and services. Of course, we know what happens. #inflation. Okay, let's look at inventory supply for a moment here. So our friends over at Altos, they are out with new numbers showing that inventory ticked up a little more, but it's still extremely low. 2% increase in inventory over the last week, but we still have a lack of supply that is constraining sales. So realtors, title companies, mortgage companies, sorry, this is the problem. It's just a lack of supply. We are in a supply-constrained market. If we had more inventory, we could sell more properties. We just don't have enough inventory. Certainly, inventory is higher than it was a year ago, 2 years ago. We all know that, but it's extremely low historically. I mean, if you look back to pre-pandemic, we're still riding at about half, 50% of the inventory levels there, and about 1/3 of normal inventory. So the only solution to this is more construction of new homes. And the only way to do that is have some big disruptive technology. And folks, it's not going to be 3D printing. Just listen to 3D printed houses. Just listen to my episodes on that. There's really nothing out there on the horizon that's any disruptive technology in housing. It's a low-tech asset class. It's hard to build. It's expensive to build. It's slow to build. It depends on numerous supply chains, and it depends on the government getting out of the way and make it easier to build with easier building codes, easier zoning requirements, and all of that stuff. And folks, this is a super slow, incredibly difficult process to have happen. So there's virtually no sign that any of that will happen to ease the inventory shortage. All right, well, let's look at some other types of data. Let's look at some Black Knight data. They keep a lot of good stuff. This is in conjunction with Realtor.com, and it shows new real estate listings. And this is the percentage of difference 2017 to 2019, same month average. Okay, so this is a different way to look at inventory. And we can see here that, back to 2017, we saw inventory above the 0% line, went up a little bit, then it went down a little bit in later 2017, up a little bit. These are just minor little fluctuations. They're statistically meaningless. But then the big one here is in 2020. We saw inventory decline during the pandemic lockdown periods, depending on where you were, whether you lived in a state that valued freedom or not, there was still some constraint no matter what. Inventory down by 37%. Huge decrease in inventory here. And then we saw it loosen a little bit, but inventory was still down by over 20%. And then it was down by about 10%. And then it was down by about 4%. And then finally, a little bit of relief as the lockdowns waned and some people came out, put their houses on the market. Everybody was getting fed up. They were getting COVID fatigue, and they put their houses on the market. Okay, so we saw all that happen. And then a little bit of spurt in inventory, but then everybody started buying those houses that went on the market, and inventory just crashed again. And there was a complete lack of inventory, right? And so we see all the months where the inventory was down into 2021. And then we see a little, bit kind of no change really, there's just not much. And then we come in to late 2021 and 2022 and just no inventory again. Inventory down by almost 20%, down. I mean, these are quarterly, right? So, down again by about 15%, down, and down here 2023 by 30%, right? So this is good because it answers the compared to what question, right? And I'll just read a little bit from the article. Our collateral analytics data showed the supply of active listings fell for the sixth straight month to the lowest inventory level since April of 2022. On top of that, March saw a deterioration in supply among 90% of major markets. New listings aren't filling the gap either. 30% fewer properties hit the market in March as compared to pre-pandemic norms. That deficit has now increased in each of the last 6 months and is up from negative 27% in February to negative 25% the month before. Given the modest rise in sales volumes, current available inventory represents just 2.6 months of supply. Remember, most people will say 6 months of inventory is somewhat normal, right? So we have less than half of normal inventory according to this type of study. When you're looking at absorption rates versus supply, how long would it take to absorb the supply? Right now, 2.6 months. All right, but we need 6 months. Again, these are different stats. This is a different kind of analysis than the Altos analysis that I showed you earlier. That's just flat numbers, right, of how many homes are for sale at any given time. So represents just 2.6 months of supply on a seasonally adjusted basis, tipping the scale back toward sellers in a tightly constricted market, unquote. That's Black Knight. Okay, let's look at this. This is the home price index. So here we are looking at a 1 month change that's annualized, another 1 month change that's not annualized, okay, and then the annual home price growth rate, either growth or decrease rate, depends, right? The chart will just show you a couple of things, but the narrative is probably more important. And here's the text, right? The only markets in the top 50 markets by population where seasonally adjusted prices are still shrinking are Austin, Texas, Salt Lake City, Utah, and San Antonio, Texas. And then Phoenix and Dallas were effectively flat month over month. The largest price gains have occurred in the Midwest and the Northeast. Now, what surprises me there? The Northeast surprises me. The Midwest does not surprise me at all. I find it kind of odd that they did not mention the Southeast, because that market is hot, hot, hot. It's where I live. It's where we're doing most of our business. The vast majority of our clients right now are buying Alabama and Florida. Those are our busiest markets, Alabama and Florida. So I'm kind of surprised they didn't mention that, but I don't know why. Can't explain. I didn't write the article, okay? All right. Then let's look at sellers that are in trouble. Delinquencies. How many people are behind? And again, their calculation is different than some of the others I've cited before. All of these sources have a little bit different way of analyzing things, calculating things, et cetera, okay? So it's all a little bit different. But here is what we've got. We've got 30 days delinquent, 60 days delinquent, 90 plus days delinquent, and overall delinquent. In other words, you're not making your mortgage payments. So how delinquent are you, and how many people are behind on mortgage payments? The narrative says, inflation does not yet appear to be hurting mortgage performance. Think about it. If the cost of living gets really high for all of the stuff that all these households have to buy, then that is going to lessen their ability to pay their mortgage. And what decision are they going to make first? They've got doctor's bills, they've got grocery and food costs, they've got school tuition, they've got car payments. Where does something break, right? Does it break with him not eating? Well, probably not. Probably everybody's going to choose to eat before they pay the mortgage, right? So it all varies. But here you can see the delinquency rate during the Great Recession and leading up to the Great Recession, and then taking a long time to work itself out of the Great Recession. We'll start this in 2005. We started to see it increase, and then it really didn't come down until 2010, 2011, right? Then it has just plummeted. I mean, it is very, very low right now. The other stat that I've cited, and by the way, I'm going to have Rick Sharga back on the show. He's got some great data, because I really wanted to get him back for an update. And about 0.5% of mortgages in default. Usually that's about 1% in some stage of default. So the default rate, very, very low. Last week, I showed you these two proformas. Again, my favorite feature of Fakebook, Facebook, the privacy invading company that doesn't think laws, rules, or decency apply to them. Anyway, look, I'm a user of their software, fait accompli. What else can we do, right? Compared to what? But 9 years ago, I posted this on Facebook, this proforma showing a property in the Atlanta metro area, Georgia, right? And this property offered a 50% projected return on investment overall. It offered a 17% cash on cash return on investment projection. People could have purchased that 9 years ago. And so many people thought, oh my gosh, the market has been improving coming out of the Great Recession. Prices have been going up. This can't continue any longer, right? But it did. And this kind of property, this sort of example property that one of our clients bought, by the way, who bought this property? I don't know. We should figure that out and contact them, because I bet their performance on this property went substantially better than projected. I bet it was much better than projected. And now, today, you look at what you can buy, and this will probably be better than projected if you hold it for 9 years. Probably much better than projected. But right now, of course, we've got high prices, we got high interest rates. Oh, that reminds me. Folks, be sure you get on our mailing list. Here's what happened last week. I was talking to the investment counselors, and I was saying, hey, do you want me to be promoting these Zoom meetings that you're all doing? They're doing like one a week or maybe one every 2 weeks. Do you want me promoting these on the podcast? And guess what they said? It really surprised me. The investment counseling team told me, no, don't promote these Zoom meetings on the podcast because we get too many people and our vendors can't handle the rush of business. Why am I telling you this? Because I'm not going to promote our 4.75% financing incredible deal on the podcast. But what I am going to tell you to do is go to jasonhartman.com, make sure you fill out any web form there, and make sure you're on our mailing list. So the emails the investment counselors send out inviting you to these Zoom meetings, you'll get them. And you can come if you want. Think about all the really interesting financing offers that we have recently. We have currently, and we've offered recently, we've had some Zoom meetings about. We had 100% financing where you only pay, in one case, we had a client who just achieved this deal. Basically, he's paying about a 0.75% premium to put nothing down. That is the deal of the century. Anyone who doesn't recognize that is just a complete fool. They're just a foolish, foolish idiot. Because think about it. They get inflation-induced debt destruction on an extra 20 to 25%. Zero down. The lender is taking the risk of that real estate investment, not the borrower. And they're only paying, in that case, now your underwriting may be different. You might pay a little more. Everybody's different. Everybody has different credit scores. This is a fully underwritten loan, okay? There's no ninja loan here. There's no income verification crap. These are fully underwritten loans. You got to qualify for the loan, okay? It's a prudent loan, but it is nothing down. So you're not going to have skin in the game. And in this case, our client only paid a 0.75% premium versus a normal mortgage. And this rate was lower than a debt service coverage ratio or DSCR mortgage, which is so popular with investors. Lots of DSCR mortgages nowadays. And if you don't know what I mean by all this stuff, I don't have time to go into it here, but get on our mailing list, go to jasonhartman.com so you'll be notified about these Zoom meetings. So we have 100% financing. We have a really interesting 40-year product. We call it the cash flow loan because it knocks down your payments. We have an interest-only product, which has been extremely rare for investors. And we also now have a 4.75% product. So that is quite a bit lower than current normal mortgage rates. And remember something, these are investor, non-owner occupied mortgage rates. They are not homeowner, owner-occupant rates, which are always lower significantly than investor loans. Investor loans, you pay a little bit of a premium, but it's still, all of these options are certainly below the rate of real inflation. Many are below the rate of official fake inflation, according to the CPI, CP lie, because we all know that CPI is a lie. So we've got some really good offers. So be sure you're on our mailing list and you get the emails. So let's get to our final thing, and it's my broad prediction. I've alluded to this before, so maybe it won't be a huge surprise to you, but let me just put it in really sort of upfront terms. And then you can check me on this 10 years from now, because this will become a Flashback Friday episode, or you'll just go back and listen to it. We don't delete the episodes, right? We're just really transparent about this stuff. My prediction is the Fed is going to pivot from their tightening plan, and they are going to be forced to let inflation run. And with a low inventory situation, we just went over it, right? We've got about 50% of the homes on the market that we had in 2019 pre-pandemic. We've got about 1/3 of the homes we need for sale to be a normal market. We've got 2.6 months of inventory when we should have 6 months of inventory to be a normal market. Remember, all of these comparisons are normal market. These are not, they call a buyer's market, the market when there's a lot of inventory, tons of homes for sale, tons of choices, sellers can't sell, sellers are lowering prices, sellers are desperate, sellers are in default. We went over all of that stuff in this show and on many other prior shows. We only have 2.6 months of inventory now. 6 months is normal. 8, 10, 12 months would be a buyer's market, a really bad market. So we are in a seller's market in all respects. Sellers are not desperate. They're not selling. They're keeping those cheap mortgages. They're not willing to sell them. They got 28 to 29 years left on those super cheap mortgages. They're going to protect them, just as I predicted during the pandemic. I said people aren't going to sell. They're not going to get rid of these mortgages. They're going to do whatever they can to hold on to them. And that prediction is coming absolutely 100,000% true. So what's going to happen? The Fed is going to give up on the tightening strategy. Do I know when? No, I don't know when. I'm just making a broad macroeconomic prediction. They're going to have to. They can't do it anymore. The banks can't withstand the pressure. Other things will break. They will probably push us into a formal declared recession. Who knows what the labor market's going to do? I think the more pressure on the labor market will not be the economy. It'll be artificial intelligence. That is going to put a lot of people out of business initially. But then that's going to create a whole bunch of new prosperity in the world. And, there's always that adjustment time, and that's the tough time. And that's why, folks, if you can get through the adjustment time, and it's usually about 18 to 24 months, right? That's always the pain time. If you can get through the pain time, you do great. I've been doing this for so many decades now that I've just seen this play out over and over again. And that's not just with income property, not just with real estate. It's with all asset classes pretty much. Well, I don't know. You talk about precious metals, those don't do much. Like everybody gets all excited. Oh, gold is soaring. Yeah, it went up $20. Okay, great. Like, how am I going to retire on that? Well, I guess if you own enough of it, you could retire, but you could have retired anyway if you owned that much gold, right? Gosh, it's just funny how the precious metals people are. But that's what's going to happen. And they're going to be forced to let inflation run because the bet they're going to have to take is the inflation bet. And they don't want to take it. They're going to get criticized extensively. But the other choice is more bank failures, more breakage in the economy, and who knows what sector of it, more pressure from business, more pressure from Wall Street. None of these things can withstand high interest rates. Oddly, the real estate market is withstanding high interest rates like a champ. It's unbelievable. I mean, can you believe these historic, insane, incredible interest rate increases we've had, and the real estate market is still chugging along? Where's the flood of inventory? Where are the flood of desperate sellers? They're just not there. It's a nothing burger. We've seen a little bit of price decline in some of these Case-Shiller markets. They only profile in the composite index 20 markets. And remember, 75% of those 20 markets are cyclical markets that none of you would ever invest in anyway. We don't recommend them. Where is the big disaster? I mean, the fact that real estate has held as well as it has with these insane interest rate increases that are causing banks to fail, causing all sorts of breakage, right? But amazingly, real estate is holding up pretty darn well. I mean, I'm even amazed, right? And, I've been pretty optimistic for quite a while now. I'll get pessimistic at some point, but not yet. So that's my prediction. You pivot and you lower interest rates even a little bit into a low inventory housing market like we have, and the housing market catches on fire and prices start going through the roof again. That's the likelihood as I see it. When will it happen? I don't know. I think it should have happened already. I can't believe the Fed hiked again last week. It's amazing. But, maybe they'll hike a couple more times. Maybe they'll just leave things alone and they won't go up or down. But eventually they're going to have to pivot. And that is going to cause even more shortage of inventory and even more competing for the existing inventory. So we'll see what happens. Write your comments below. Tell me I'm right on. Tell me I'm crazy and I'm wrong and I'm an idiot. Whatever you want, I'll read them below. just be civil. Okay, that's all I ask. And, everybody's got their opinion, but I'll bet you I have more experience than most of these people with their opinions. Just count the number of years I've been doing this. It's a lot of them. All right. Be sure to get on our mailing list so you get the updates on the Zoom meetings and so forth, so you get invited to those. And we will look forward to seeing you on Wednesday's episode. Until then, happy investing. Reach out if you need us. We're here for you. Talk to you soon.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.